So in this video, I want to talk about this little trick I use to save on commissions with Questrade. And then I want to talk about some trades that I made today. So if you have active trader pricing with Questrade, which anyone can have, or you don't have to be an active trader or actually make a certain amount of trades to get active trader pricing, anyone can get it, but it does cost $89 a month, either 89 US or 89 Canadian, depending which data package you want it to come with. So I took active trader pricing because of the options. Options with active trader pricing is $4.95 flat fee plus 75 cents a contract. Otherwise, the regular trading commissions is $10 plus $10 flat plus $1 a contract. But there is another advantage to active trader pricing, and which I'm going to explain right now. So today I closed two put spreads that were profitable today. So if you watch my previous videos, you know that I do put spreads on the SPY every Monday, Wednesday, Friday, collect whatever I can collect, let's say 80 cents. And whenever the spread is trading for 40 cents or 50% of the original premium that I collected, I'm going to close the trade. So because the SPY and the market is flying right now, so all these put spreads that I'm opening, I'm able to close them pretty quickly. So today, if we look at executed, you could see this line over here, okay? So you can see that this line over here is a combination of two put spreads. It's got the June 22nd put spread and a June 19 put spread. The June 22nd put spread has a 276, 271 strike, and the June 19 put spread has a 279, 274 strike. So by combining the trade, by placing the trade together, I'm able to save on commissions. So if you look at this line here, you can see that this is one put spread, this is one trade that I closed. I paid 40 cents to close it, or $40, but the commission on this is $5 to open the trade plus 75 cents a contract. So since there's two legs, so it's $5 plus 75 cents times 2, so $5 plus $1.50, so $6.50 just for closing this trade here. But this trade here, as you can see on the line, it has two put spreads combined. So what I save on is that $5 flat fee. By opening this trade, by closing this trade, I only had to pay $5 once. The 75 cents per contract, or the variable portion of the commission, that doesn't change whether it's combined in one trade or separate trades. But what I save on is that $5 flat fee. So now I paid only $5 for this trade, but it had two different spreads. So it's as if I only paid $2.50 per spread. $2.50 for this one and $2.50 for this put spread. So basically, if I place a put spread with several contracts, so let's say I've got 10 contracts, I'm still going to pay $5 flat fee, but I'm going to pay 75 cents per contract. So if it's a put spread, then it's got two legs, so I'm going to be paying 75 cents times 20. So I'll be paying $15 on the variable portion and then $5 on the flat fee portion. So at the end of the day, if I take the total amount spent in commission, that's $20, divided by the number of contracts or legs, I'm paying $1 per contract in that case, which is actually pretty good compared to other brokers. I mean, with Interactive Brokers, which is known to be very cheap for option selling, sometimes you pay $1.30 per leg. So in this case, or in this situation, Questrade would actually be cheaper. So I guess the more contracts you trade at the same time, the cheaper Questrade becomes if you've got active trader pricing, because that $5 flat fee gets diluted. So that's a little trick I use to dilute that $5 by combining trades if I can. So how do you combine a trade if you want to close it? So let's say I want to close this trade and this trade, so two different trades. It has to be the same underlying though. It cannot be two different underlying. So let's say I've got two put spreads here, June 26th, June 24th, and I wanted to close them together. So I can click on one of them, click create order, and as you can see, it shows up on the order entry window here. And I want to add this one too. So the way I would add this one is I would come here and click customize, and then I've got options: add call, add put, add stock. So I want to add puts because I want to add these two legs over here to my entry, to my trade, so that I can save on commission. So I simply click put, and then I have to match it. So I want June 24th, 285 put, and June 24th, 285 put, and then I've got another June 24th, 280 puts. I'm going to add put again. So I'm going to click on add put again, and I'm going to go choose the expiry, June 24th, 280 put this time. So just making sure that the numbers are the same, right? So June 24th, 285, 280, put. And so this one is a sold put. So if I want to close it, I want to buy it back. So I have to make sure that it's buy. And this one is a bought put. So if I want to close it, I want to sell. So sell. So now I'm ready to actually close both of these put spreads, separate put spreads. I'm able to close them together in one trade. And that's why the option type says custom. And therefore I get to save on commissions. So instead of paying $5 twice, I only pay $5 once. And as you can see, I can no longer highlight add put or add call. So it limits me to 4 legs, but I could add more contracts if I had. So I could do several contracts at the same time as well. So contracts is the variable portion. So it doesn't matter whether you do it in the same trade or not. But if you can combine trades, then you save on the fixed portion, which is the $5 in this case. All right, so I'm recording this video Thursday, May 28th, but Wednesday, May 27th, I placed a put spread like I normally do, the June 26th expiry, 285, 280, and I believe I collected about 81 cents on that one. So I win as long as the SPY stays above 285 come June 26th. So today, May 28th, I placed an earnings trade on Alta. I did my regular 30-day put spread. So I went at a June 26th expiration, 210 short strike, okay, 5-point wide. Collected, I believe, 99 cents on that one. If I go to orders executed, yeah, there you go. I collected 99 cents. And if I go back to positions, so yeah. So if we look at Alta right now, after hours, it's trading at around 243. So it didn't move much. But what I'm counting on is that tomorrow it stays at the same price or goes a little bit higher. And then there's a volatility crush in the premiums because earnings is announced. So there's no more mystery. And that I'm able to close the trade for at least 50% profit. Similar to the NVIDIA trade, if you saw that video on the NVIDIA earnings trade. And if it doesn't go higher, if it drops, I've got room. My short strike is 210. So as long as it doesn't drop below 210 by June 26th, I could still win on this trade. But of course, I would prefer to close it earlier and not have to wait until June 26th. And there's a good chance of that happening because of the volatility crush that happens after earnings. For example, Alibaba was an earnings trade, but didn't go well because Alibaba dropped from 210 to 200 after earnings. So I'm still in the trade. I'm not able to close Alibaba, but I'm not losing either because my short strike is 190. So I'm giving myself some room for error so I can still win if I'm wrong on the direction, which most of the time I am wrong on the direction. Now, I was very tempted to do a straddle, to sell a straddle on Ulta at the May 29th expiration, so same week expiration, because I know it would die quickly. And I would have been able to collect about $20 if I sold the straddle. So similar to the NVIDIA earnings trade of last week, if I collect $20, that means for me to win, I would need Alta to close tomorrow. So to open tomorrow anywhere between 245 plus 20 and 245 minus 20. So I've got a 40-point range where I could still make a profit. Right now, it looks like if it opens at 243 and closes the day tomorrow at 243, then the $20 straddle that I sold, I could buy it back for $2 only. So that means I would make an $1,800 profit. But it's a naked trade, so the potential for loss is unknown and not defined. So that's the scary part of it. So that's why I don't place them. It scares me. But every time I think about it, test it out, the next day I find out that if I had placed it, I would have profited a lot. So maybe it is a trade that sometimes you will lose a lot, but the more you place them, overall you will win. But I just know that I wouldn't be able to handle the times or the rare times that it would be a big loser. So for that reason, I'm staying away from it, but I still like to look at it just to see what would have happened. So right now, if I had sold the straddle before market close, I would have collected $20 at the 245 strike. We'll see tomorrow what happens, what the straddle is trading at, just for curiosity, just to see how much profit I could have made in one night. But instead, I placed a put spread at a 210 strike, collecting $99. So much different dollar amount, but it's it's a defined risk trade, so there isn't so I know what my maximum loss is, and I can actually reduce the maximum loss as the trade goes against me. So this, I find this much safer, less stressful, and more representative of my personality. Although the straddle is very tempting. I think one day I'll do it, but I don't think I'm ready right now for selling the straddle before earnings. Alright, so if you have any questions, leave in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back depending on your deposit, and the other one gives you $50 in free trades regardless of your deposit. And if you did enjoy this video, remember to click the like button, share with a friend, and subscribe to the channel. Thanks for watching.